So we just heard from the Bank of Canada's Governor Tiff Macklem, and we heard some pretty impactful information during this press conference. This is going to be a one-taker video because I took a lot of notes live on the stream when we were sort of watching this all together. So if you want to know all of the different information that was revealed at this press conference, this is the video for you. So the Bank of Canada came in today with their what seems to be their final interest rate increase, raising their key policy rate, their interest rate, by 0.25%. So this is expected to sort of go into all different areas of the economy, but most quickly into the real estate and other industries that are heavily tied to interest rate increases. We generally see a large impact when this rate goes up on real estate prices because it makes houses less affordable because people have to pay a higher interest rate on that. So that's the big decision from today, that 0.25% increase. But there were a lot of other insights in here, and let's go through them note by note here. Forgive me for looking over at my notes on the monitor here because we went through a lot and we're going to go through a lot right now, rapid fire. So they said that their decision has two elements, sort of two things that went into making this decision. They're continuing their quantitative tightening, and this is going to be a deflationary impact or like a disinflationary, a downward pressure on inflation. That quantitative tightening is referring to the reverse of quantitative easing or the money printing they did at the beginning of the pandemic. Instead, they're going to let the bonds that they purchased roll off of their balance sheet, and that selling pressure in the bond market should push rates down a little, or actually push rates up rather. Yeah, because as bond prices go down, bond yields go up. And the other key thing that they indicated was that they are in fact pausing. They're not going to be looking at future meetings at actually raising interest rates. They're going to just pause and see if all of this stuff is actually going to impact the economy, let it trickle through. They say that their restrictive monetary policy that they've been doing since March or April of 2022 is in fact slowing growth, but we still have excess demand in the economy. The economy is still overheated and it's not cooling as much as they expected it to. We've seen the CPI decline, the Consumer Price Index, the sort of tracker of the cost of living and how that grows over time. We've seen CPI decline in terms of its pace of increasing, but that CPI is different from another metric that the Bank of Canada looks at, which is core CPI or core inflation. This is an inflation metric that cuts out some of the more volatile elements of the CPI, such as fuel and food prices, things that are less domestic and more international. So they cut those things out and they're saying, hey, with those two things cut out that are very volatile, we're still seeing core CPI very high, and we're not really a big fan of that, which is likely why they raised a quarter point today. They said that their quantitative tightening that we just discussed is, however, complementing their restrictively high interest rates. But they project that the full impact of these interest rate increases has not yet been felt in the economy. This is some kind of bearish information that the Bank of Canada is putting out there saying, hey, we really increased interest rates an entire 4% or 4.25% since the beginning of when they started raising it. And they don't believe, the Bank of Canada doesn't believe that these interest rates have actually been fully felt in the economy. We haven't seen a cooling in jobs. We haven't seen a cooling in wages like you might expect if these interest rates were high for long. So they're saying over the next 6 months, next year, we're expecting the labor market to cool, and we're expecting to see all sort of areas of business slow down, much like real estate has slowed down because it's more abruptly impacted by these interest rate impacts. They say that they're because they haven't felt the full impact of it, that's why they're pausing, but this pause is conditional on the economic situation evolving in the way that they expect and actually hitting the CPI targets that they've projected, which is one of the other major insights that we got from this monetary policy report, and that is that they have new CPI targets. They're expecting in the next 6 months, they said mid-2023, that CPI will be back down to 3%, and that in 2024, they'll be back down to their 2% target. This is a big change from inflation sitting around 6% in the sixes where we are today, going down an entire 3% to the upper limit of their band of acceptable inflation, which is 1 to 3%. That's where they're saying, okay, that kind of range of inflation is pretty okay. So that's where we're targeting. So 3% by midway through this year, 2% by 2024. So they say that in order for them to continue this pause, they're not even talking about cutting rates at any time soon, but in order for them to not hike again in the future, they would need to see these CPI targets hit and things going in the way that they've projected them to. But they say there are some major near-term risks that could alter their projections, right? One is the global energy prices increasing. They don't have a lot of control over this. If energy prices were to increase, this would be an inflationary pressure, and that could cause them to not hit those CPI targets that they've really honed in on here. But they say that they're still more concerned about the upside risk, which is that inflation is stickier, especially in services, than they would expect. They seeing that price increases could stick around for a while with wage increases and businesses having to pass on those costs to consumers of higher wage prices, that could be a higher inflationary pressure, and that it could stick around for the long term. So there's upside inflationary risk and downside inflationary risk. But the message to Canadians that are struggling with the rising cost of living, this is what Governor Tiff Macklem really emphasized, is that's why that we are turning the corner when it comes to inflation. They're expecting it to come down, and they of course need to sort of put this out there because they want people to believe that the Bank of Canada has this under control. This is another policy tool, right? The way they talk about things actually has an impact on the economy. So that is quite interesting. So that was the entire press conference, but then we got into some of the more juicy stuff, which is what the Bank of Canada responded to. These were questions from reporters. They sort of will ask more uncomfortable questions, and we often get the juiciest information from these questions. So the one question was, while we see that the pause is most likely for the next while, what would you need to see in order for you to start hiking interest rates again? They said that they needed time to assess. They don't want to over tighten, right? That's a downside risk. If they over tighten, raise interest rates too much, and their monetary policy is too restrictive, well, that could be extremely painful for the average Canadian who's dealing with a prolonged recession. So they don't want to over hike to create this really deep recession. And as long as they hit their CPI projections, it's going to confirm that they've done enough and that they could pause for the long term and even pivot potentially by the end of this year if we see something and actually lower rates. But they're going to be looking at the data as things evolve. The next question was about the housing market. Inside of the monetary policy report, which was just released today along with this decision, they said that they expect housing to decline over the next 6 months. But what we don't know is the full magnitude of how far housing prices will decline. There are some things that are suggesting that this could be a more shallow housing decline than some could expect, and that we'll actually see increases in housing prices sooner rather than later. The reason people are saying this is because the 5 and 10-year bond markets, yields on those bonds are coming down. Now, the reason that impacts real estate is because those bond markets highly impact the rates at which people can borrow for mortgages. So if we have lower rates on 5 and 10-year bonds, then we likely have lower rates on mortgages, which encourages buying, right? So that's why folks are wondering, will this be a more mild housing recession, especially with immigration targets being increased to 500,000 new Canadians a year? To that, the Bank of Canada said, so far, the decrease in housing prices that we've seen has been in line with our expectations, coming down off the extreme highs of the pandemic. They said that the pandemic market was unsustainable, and that they expect the further pullback back over the next 6 months, but that the fundamentals that we've talked about, immigration and bond prices stabilizing, maybe even coming down, could lead to an increase in real estate prices or a slowing of the amount of declines that we see. So that was some insight on the housing market. Really interesting to hear the Bank of Canada's perspective on that. Continuing on with our rapid fire notes from this press conference, one question was, since 3% is the upper band of where you want inflation to be, would you consider cutting rates once you get to 3%? Like, is 3% going to be good enough for you to stimulate the economy again? To that, the Bank of Canada and Tiff Macklem responded, hey, whoa, this is going way too fast, folks. We are not going to talk about cutting rates yet. It's way too early to talk about rates. This is what the Bank of Canada is saying. We're only pausing to evaluate to see if the interest rate increases we've done will be enough to impact the economy in the way that we want it to. He then goes on to say the band is not a zone of indifference. We want 2%. We target 2%, but that 1 to 3% is just a range to set Canadians' expectations that they should, in a reasonable economy, expect inflation between 1 and 3%. But the Bank of Canada is dead set on that 2% rate that they are saying will happen in 2024. Now, whether or not you believe we're going to get there or not is an entirely different question. Another question here is, how do you reconcile your new targets for inflation with consumer expectations of inflation higher over the long term? Now, inflation expectations of average Canadians has a big impact on inflation, right? Because if Canadians believe that tomorrow things are going to be more expensive than they are today, right? In a period of high inflation, that's what you get. Then the average Canadian would think, okay, if things are going to be more expensive tomorrow, I'm going to buy things today before they get more expensive. Now, that in and of itself is an inflationary pressure because it brings forward more spending in the economy that would have happened later, right? Because of this expectation that things will be more expensive in the future. To that, the Bank of Canada said, we're seeing evidence that the rapid increases in interest rates that we've done over the past year are working, especially slowing interest rate sensitive areas of the economy, housing and sort of industries related to housing. Now they're looking at the 3-month average for inflation, something we talked about on the channel that is definitely having a decrease. We're actually seeing, if you were to annualize out the 3-month trend, that we would be around the range of 2% inflation, which is where the Bank of Canada wants it. So that is something that's making them confident to pause now to sort of see where all the cards fall at the end of the day. Then we got an interesting insight into the Bank of Canada's balance sheet. You might have seen headlines saying the Bank of Canada has lost $500 million in Q3 of 2022, losing money extremely quickly. We won't go into all the mechanizations of how this actually works. Largely it's because they're paying more on deposits that big banks have with the Bank of Canada than they're earning on their bonds now because of the way that bond yields have changed. So that is something that's leading them to lose money. Typically, when the Bank of Canada makes money, they'll give all this money to the government at the end of the year. But now they've actually lost money, so they're going to ask for money from the Canadian government to sort of fill this hole. It seems here that the Bank of Canada, and this is the first breaking news that we've gotten about this, is that the Bank of Canada governor has talked with Chrystia Freeland, the Minister of Finance in the Liberal government, and she says that they are going to change regulations to allow the Bank of Canada to retain earnings and what sounds like to retain losses, sort of not have to pay them and just sort of create a deferred asset that they can sort of pay back over time. So instead of the Bank of Canada having to get paid by the government of Canada to fill that hole, instead they can just sort of keep that hole there as a debt, and in future years when they get back to positive equity, they'll start sort of paying back that big hole, and then once they are fully out of it, they'll start paying the government again whatever increases they see. So that's interesting to hear that is the direction they're going. Then there was talk about the labor market in Canada. I'm wondering, is there too much fear around the wage price spiral risk? Of course, that wage price spiral is in relation to the inflationary impact of higher wages, which we've talked about already a little bit. The Bank of Canada says the labor market's still very tight, and we still need to see cooling here in order to balance inflation and get the economy right in the right spot where we want it. For a wage price spiral, with inflation going up quickly, they have been concerned about this. If people expect high inflation, then more wage increases will be worked in to those job offers and as an incentive to keep employees at your company. But what the Bank of Canada is saying is that they're seeing wage increases be steady over the long term at 5%, sort of plateauing. What they would have been concerned about is if wage price increases went above 5% and sort of continued an upward trajectory. Right now, they're sticking around 5%, have been that way for the past 4 months or so, and they're actually expecting to see this come down because they said that if it were to remain at 5% wage growth over the long term, that would be inflationary unless we simultaneously have a very high productivity growth, right? If average Canadians can be more productive on average, then a 5% wage gain isn't inflationary. It's just a result of being more productive. But if we do see that 5% without the growth in productivity, well, that would be an inflationary impact. Then the Bank of Canada was asked about their prospects of a recession. Do you see a recession coming in the future? Especially because yesterday, experts that were talking to the Liberal government, the Liberal cabinet, sort of advising them to help them draft new policy for this upcoming sitting in the House of Commons, those experts said that they wouldn't rule out a hard landing, meaning a very long and prolonged recession. But the Bank of Canada sees things differently, predicting a soft landing, kind of predicting that they're going to do a good job with managing things. Now, to this question, the Bank of Canada said, hey, we're going to see pretty much zero growth over the next year. We need this for supply to catch up to demand. That means like a 0% growth in GDP, which is something that in normal times would be absolutely awful. But the Bank of Canada is saying this is going to be painful. We're going to have to deal with this lack of growth, a sort of stagnation in terms of quality of life in Canada in order to get inflation under control, get demand back in line with supply. But they don't see this being a major contraction, though they do recognize that this is going to hurt individual Canadians. And when asked what his final message was to Canadians who are struggling with the high cost of living while simultaneously dealing with high borrowing costs because of the raising interest rates of the Bank of Canada, Tiff said to Canadians, we know inflation is still too high. 6% is better than 8%, which it was before, but low-income Canadians are impacted heavily by this because they don't have a buffer of savings to sort of buffer against these price increases. So this is impacting low-income Canadians the most, and we recognize that. The second message that the Bank of Canada said is one of confidence. We've got this under control. We've already raised rates by 4.25%, 425 basis points. We think that's going to be enough. That's why we're pausing here to see how things develop over the future. So we've got it under control is the Bank of Canada's messaging. Of course, whenever you hear a message from the Bank of Canada, you think, what does that do to the economy? Because of course, forward guidance is one of their key tools that can impact the Canadian economy. So you got to take that with a grain of salt. So that's the overview of everything that happened in this press conference. I hope that you found that at least a little bit helpful. If you haven't already done so, make sure to subscribe to the channel for more Canadian-focused financial updates just like this one. And with all that said, thanks so much for watching, and I'll see you next time.